We often hear that the market is a casino, a place of chance where fortunes are made and lost on a whim. During times of volatility, this feeling intensifies. The natural instinct kicks in to either sell everything in a panic or to spread your investments so thinly across so many assets that you essentially dilute your potential for meaningful growth, chasing a mediocrity that offers little true protection. It's a foundation built on sand, easily washed away by the next market tide. But what if there was a different way? A way that honors the wisdom of those who have navigated these choppy waters for decades. Warren Buffett, a titan of investing, once famously stated, Rule No. 1, never lose money. Rule No. 2, never forget Rule No. 1. This sounds simple, almost axiomatic, yet in the heat of market downturns, its true implementation becomes a profound challenge. How do we truly build a portfolio that adheres to these fundamental principles when the ground beneath us seems to shake? This isn't about predicting the unpredictable, an endeavor that history tells us is a fool's errand. Instead, we will dissect what I call the 4 pillars of portfolio construction. These are not mere industry buzzwords or fleeting trends. They are deeply analyzed, data-backed strategies that, when understood and applied with discipline, form a robust framework. A framework designed not just to withstand market storms, but to emerge from them stronger, more resilient, and better positioned for sustainable wealth accumulation. This is about building a portfolio that thrives because of market fluctuations, not in spite of them. Are you ready to explore this unshakable defense? Benjamin Graham, the father of value investing, gifted us the profound concept of the margin of safety. We often think of this in terms of individual stocks, buying them when their market price is significantly below their intrinsic value. But this principle is far more expansive. It is a critical lens through which we must construct our entire portfolio, not just individual holdings. To misunderstand this principle when it comes to asset allocation is to build a defense that is, in reality, a vulnerability. Consider the historical data. When we look back at periods of intense market turbulence, the dot-com bust of 2000, the global financial crisis of 2008, or the sharp shocks of 2020, a clear pattern emerges. Simple diversification, the act of spreading investments across various asset classes without a deeper analytical framework, often fails to provide true downside protection. It can lead to a portfolio that is merely mediocre, experiencing muted gains in good times and still significant pain in bad. The true safety, the resilience we seek, comes from something more fundamental. There's a persistent myth that simply buying assets that appear cheap automatically confers safety, but the real margin of safety lies in something far more rigorous. It's about understanding the intrinsic value of an asset class relative to its current price, and applying this understanding consistently, especially when market sentiment turns fearful. When panic grips the markets, the assets that offer genuine protection are those where the price reflects a deep discount to their underlying enduring worth. So, how do we quantitatively assess and implement this margin of safety in our asset allocation? It begins with moving beyond simplistic models like the traditional 60/40ths portfolio. We must delve into valuation metrics specific to different asset classes and examine historical risk premiums. This data-driven approach allows us to build a framework where safety is not an afterthought, but an inherent characteristic of our portfolio's construction. The hidden cost of a portfolio devoid of this margin of safety is not merely the potential for amplified losses. It is the erosion of our confidence, the emotional toll of constant anxiety, and the significant damage to the compounding power of our wealth. When volatility inevitably strikes, volatility has a peculiar way of exposing the underlying fragility of assets. It's during these turbulent times that the true character of an investment is revealed. This brings us to our second pillar, the quality filter. This isn't about chasing the latest hot stock or the most talked about sector. It's about identifying companies and assets that possess durable competitive advantages, what Warren Buffett and Charlie Munger often refer to as economic moats. These are the moats that allow businesses to withstand economic storms, to continue operating and even thriving when others falter. To implement this filter, we must look beyond surface-level metrics. It requires a deep dive into financial statements, yes, but it also demands an understanding of qualitative factors. We need to assess the quality of management, the strength of a brand, the power of network effects, or any other factor that creates a sustainable competitive edge. History offers compelling examples of high-quality companies that not only survived downturns, but significantly outperformed their lower-quality peers. They demonstrated resilience not by chance, but by design. Yet, there's a persistent behavioral trap that ensnares many investors, especially during periods of uncertainty. They flock to speculative, low-quality assets, mistaking a low price for genuine value. They chase the illusion of easy money, ignoring the fundamental risks embedded in businesses with weak moats or precarious financial health. This is the siren song of speculation, leading many onto the rocks of significant loss. downturns. So, let's outline a step-by-step approach to implementing this quality filter in your portfolio construction. This involves identifying key metrics for financial health, such as robust balance sheets and consistent profitability, as well as assessing competitive positioning. Applying these criteria rigorously helps to ensure that the assets you hold are built to last. Because when you invest in quality, you're not just protecting your capital from erosion, you're unlocking the true compounding power of enduring value, turning volatility from a threat into an opportunity for superior long-term growth. Protecting a portfolio isn't solely about building a fortress to keep losses out. It's also about strategically structuring investments so that the potential upside is disproportionately greater than the potential downside. This is the essence of creating asymmetric payoffs. It's a nuanced approach that moves beyond the simple calculus of risk and reward to a more sophisticated understanding of how to position capital for optimal outcomes, especially when the market is volatile. This pillar involves exploring specific strategies. Consider, for instance, the defensive use of options, not for speculation, but to cap potential losses on existing holdings, or certain alternative investments and specific equity structures that, by their very nature, offer this favorable payoff profile. We can support this by examining quantitative analysis of risk-reward ratios, demonstrating how these strategies can provide robust protection while still allowing for significant gains. We must also debunk a common fallacy, the simplistic notion that higher risk automatically equates to higher reward. This is often a misleading oversimplification. The true objective for a resilient portfolio is not simply to take on more risk, but to seek controlled risk, asymmetric reward. This is the approach that genuinely protects and grows wealth over the long term, turning potential market downturns into opportunities for outsized gains relative to the risk undertaken. Implementing this requires a practical framework. How do we identify and integrate assets or strategies with this asymmetric payoff potential into a diversified portfolio? It hinges on a strict focus on risk management and selecting investments based on clearly defined objectives. The psychological impact of this approach is also profound. Structuring your portfolio for asymmetric payoffs can significantly reduce fear and anxiety during market downturns, fostering disciplined decision-making and reinforcing your long-term commitment to your financial goals. It transforms the experience of volatility from one of dread to one of calculated opportunity. A portfolio built on solid pillars is essential, but even the strongest structure needs to adapt. A static portfolio, by its very nature, offers a static defense. In the ever-shifting landscape of financial markets, this is insufficient. This brings us to our fourth pillar, dynamic rebalancing. This is about the critical role of adaptive, data-driven adjustments that go far beyond simple, time-based checkups. It's about intelligent adaptation. To understand its power, we must look at historical market cycles. How do different asset classes perform as economic tides shift? By analyzing these patterns, we can demonstrate how dynamic rebalancing, informed by current valuations and macroeconomic trends, can not only enhance returns, but crucially, reduce drawdowns during volatile periods. It's about using the market's own movements to your advantage, rather than being swept away by them. Yet, a significant behavioral bias often hinders this crucial process. Stickiness. Investors frequently resist rebalancing. They cling to past allocations, perhaps influenced by sunk costs or a reluctance to realize gains or losses. This inaction, this inertia, is precisely what amplifies risk when markets become volatile. It's like refusing to adjust your sails when the wind changes direction, hoping the storm will simply pass you by. So, let's consider a practical guide to dynamic rebalancing. This involves defining clear triggers. These might be specific valuation bands for asset classes or volatility thresholds that signal a need for review. The methodology itself can be value-driven, focusing on restoring optimal valuations, or risk-driven, adjusting to manage emerging threats. Implementing these adjustments without emotional interference is key. The compounding effect of this disciplined adaptation is profound. A portfolio that intelligently adjusts to market realities can capture emerging opportunities and mitigate risks far more effectively than a passive, rigid approach. It ensures your defense remains robust, no matter the market tide. We've explored the four essential pillars that form the bedrock of a portfolio truly resilient to volatility: the margin of safety in asset allocation, the quality filter for identifying enduring value, the strategic embrace of asymmetric payoffs, and the adaptive power of dynamic rebalancing. Now, let's bring these elements together. How do they work in concert? It's not about implementing one in isolation, but about understanding how they synergize to create a structure that is a fortress, not a fragile castle, against market shocks. Imagine constructing a hypothetical portfolio designed specifically to withstand significant market dislocations. By applying these four pillars, we can see the intricate interplay between each element. The margin of safety provides the initial buffer. The quality filter ensures we are holding strong assets. Asymmetric Asymmetric payoffs position us to benefit more from upside than downside, and dynamic rebalancing allows us to adapt as conditions change. Together, they create a cohesive and robust defense. Conversely, consider the hidden systemic risks of ignoring these pillars. A portfolio built on conventional, unexamined diversification can, during widespread market dislocations, become a significant liability. When everything moves in lockstep, that perceived safety evaporates, leaving investors exposed precisely when they need protection most. This is the danger of relying on superficial strategies. For you, the ambitious investor, this translates into actionable steps. I encourage you to evaluate your current portfolio against these 4 pillars. Where are the potential weaknesses? Are you truly implementing a margin of safety? Is your focus on quality unwavering? Are your investments structured for asymmetric payoffs? Is your rebalancing strategy dynamic and data-driven? Identifying these areas for improvement is the first step toward building a more robust financial future. The ultimate goal is not to eliminate volatility entirely. That is an impossible dream. Instead, it is to build unwavering confidence and certainty in your financial strategy, knowing that your portfolio is engineered not just to survive, but to protect and grow through any market condition. We've journeyed together, moving beyond the superficial comfort of conventional diversification to the robust, foundational pillars that truly shield a portfolio against the unpredictable onslaught of volatility. We've dissected the margin of safety in asset allocation, the critical importance of the quality filter, the strategic advantage of asymmetric payoffs, and the adaptive power of dynamic rebalancing. These are not mere concepts, they are the building blocks of a strategy designed for enduring resilience. As Benjamin Graham so wisely observed, the investor's chief problem is likely to be his own emotions. This is where the true power of these data-driven pillars lies. By implementing them with discipline, you erect a strategic armor not just against market fluctuations, but against the very emotional impulses that can derail even the most well-intentioned investors. Fear and greed, amplified by volatility, lose their grip when confronted with a well-constructed, rationally managed portfolio. This approach is fundamentally different from chasing market predictions. It's not about forecasting the unpredictable future. Instead, it's about the deliberate construction of a financial structure that is inherently robust and adaptable, a structure capable of not just surviving periods of uncertainty, but of actively thriving within them, capturing opportunities that arise from instability. It's about transforming your portfolio from a fragile hope into a fortified reality. I urge you now to commit to assessing your current financial holdings through the lens of these 4 pillars. Where do you stand? Are there gaps in your defense? The journey towards sustainable wealth, toward true financial mastery, is not paved with luck or guesswork. It is built, brick by painstaking brick, on a foundation of resilience, informed strategy, and unwavering discipline. This is the path to not just enduring markets, but to mastering them.